Markets, they have reacted to the weak cues coming in from Wall Street. Remember, last evening, or rather the previous trading session, we saw a sharp cut on Dow as well as S&P and NASDAQ. All these indices now have turned negative for this year. The Asian markets taking cues from that. The Japanese index lower by about 0.8%, and this despite a weakness that we've seen on the dollar yen. Remember, the dollar index has inched up a little bit from levels of 96 yesterday to closer to 97. The market, despite some positive news coming in terms of currency depreciation, weakness from the Dow Jones as well as the Wall Street indices. The Korean index should come up for you, that one too, trading with cuts of over 1%. Similar is sort of the cuts that we're seeing on both the Straits as well as the Taiwanese indices. The most important though would be SGX Nifty. Remember, for India, the cues would be divergent, and there we have it. Lower crude, better for the Indian markets, and yesterday we had corrected about 1%. And while the SGX Nifty, for starters, is indicating a cut of about 10 points, if you take it in perspective with the sort of cuts that we're seeing across the Asian markets and the cuts that we saw across the world markets, the Street would take this with both hands. Just a 10-point cut as against the other indices, which are trading with much deeper cuts.
Okay, well, let's tell you about Wall Street then. We had U.S. market stocks which closed sharply lower, fueled by a selling in technology shares. The Dow and S&P turned negative for the year, with the Dow dropping 550 points and the S&P as well. The NASDAQ composite also dropped around 1.7%. CNBC's Leslie Picker gets us a wrap of all what really shook the U.S. markets up.
U.S. stocks routed in a massive sell-off, the Dow nosediving by as much as 648 points at its worst. All 11 S&P sectors finishing low day. The Dow closing with a loss of 551 points, the S&P dropping 48, and NASDAQ shedding 119. Shares of Target tumbling 10% today after the company's third quarter earnings report fell short of analyst expectations. Investments in its supply chain and labor costs are thought to have weighed heavily on its profits. The retailer also posting lighter than forecast same-store sales. The FANG stocks, Facebook, Amazon, Apple, Netflix, and Alphabet also getting hit in today's sell-off, collectively losing more than $1 trillion in market value from recent highs amid the rout in tech. Apple leading the group's loss 5% in trading today. And if today's sell-off has you pessimistic, you're not alone. Just over half of CNBC's Global CFO Council says the Dow will drop another 2,000 points, diving below 23,000 points before the Dow can approach its all-time high again. With over half surveyed CFOs responding negatively, only 13% are bullish on markets rallying to a new record high before another major drop. The number one concern weighing on CFOs is trade. That and worries about a slowing economy are shrouding the corporate outlook. That's the action from the U.S. market. Back to you in Mumbai.
All right, the CNBC CFO survey saying that the Dow may fall further 2,000 points. So that is something the Street will be watching for. But on that note, here's some opinion coming in from global experts on the road ahead for the U.S. markets and the Fed rate trajectory.
I think, you're going to get some relief. It's going to be at some point next year. I think one thing that's interesting about Fed communications is that there's always a balance. So if you can identify a dovish element to communications, there's probably an underlying hawkish one as well. I'd say based on Powell's comments, Clarida's comments, based on the Fed's own projections that they're going to slow down and eventually stop out in 2020, 2021, this Fed hiking cycle is not going to go on forever. They're laying the groundwork for slowing down next year. That's the dovish element. What's the hawkish counterpoint to that? Is the fact that they're going to continue going in the near term. December is pretty much nailed on. I don't think this market volatility is sufficient to trigger the Powell put, and they'll probably go into the beginning of next year until they get closer to neutral.
If you look at the technology route in particular, think about it. Technology is one of the most export-sensitive sectors. It is absolutely no surprise that you're seeing these names start to capitulate here. And for us, when we think about the market as a whole, this correction looks like a typical correction. The stock market will definitely respond favorably to that. And then ultimately, 3 and 6 months from now, we will look at this as a typical 10% plus correction.
Okay, well, President Donald Trump once again took a shot at the Fed Reserve, saying he would like to see lower rates from the U.S. Central Bank. Listen in.
I'd like to see the Fed with a lower interest rate. I think the rate's too high. I think we have much more of a Fed problem than we have a problem with anyone else.
All right, so that was Donald Trump's commentary or expectations on the Fed rate trajectory. But remember, the Fed has raised interest rates 3 times this year, expected to hike once more in the December policy. CNBC's Steve Leisman reports on how this and the recent market developments could actually impact the Fed decision in the upcoming policy.
Our president in the past has said the Fed has, quote, gone crazy. These recent comments might seem benign, but they come with at least some members of the Fed questioning whether they ought to hike even in December. Trouble is, the more the president says, the more the Fed is going to appear to be knuckling under to political pressure if it doesn't hike. Here are the probabilities now. We're looking at a 75% probability of a December hike. That's down from a 90% probability a few weeks ago. Pardon me. June now is the odds-on bet for the first hike of 2019. It had been March, so that's been pushed into the future. And then we can't even get to a 50% probability right now for a second hike in October, which is 31%. Last week, Philly Fed President Patrick Harker said, quote, "At this point, I'm not convinced data for the next few weeks." On Monday, here's what Fed President John Williams said: "We'll be likely raising interest rates somewhat, but it's really in the context of a very strong economy. We're not on a preset course. We'll adjust how we do monetary policy to do our best to keep this economy going strong with low inflation." The center of the board still seems committed to bringing the funds rate to what they call neutral. That's in a range of 2.5% to 3.5%. I think it's going to require more than a stock market sell-off to keep the Fed from going to 3. The data will have to weaken. If it does, the Fed could pause in the lower range of neutral, which still means we'll have work to do, just not maybe as much as the market at first thought.
All right, and across the Atlantic in Europe's markets ended sharply lower, extending the global sell-off. So tech stocks, basic resources, as well as chemicals and financials, all of them being among the worst performers. The key underperformance came in from the German index, DAX, which was down by about 1.6%, led lower by about a near 5% cut seen on Deutsche Bank itself. The FTSE was a mild outperformer with a cut of about 0.75%. The big development there would be the Brexit talks. On Sunday, there is the meeting where a decision is likely. There was a bit of an appreciation that we saw on the currency out there. Across the peripheral indices too, we saw a fair amount of cut. In individual stocks, on the French index, we had Renault, which saw a cut of about 1.5%. This after a 9% drop that we saw in yesterday's trading session once the Nissan CEO was dead. Let's take a look at the emerging market space as well. As there was a sharp sell-off across the world, we saw a big cut in the Russian index too, down by about 1.66%.
Okay, well, let's tell you about the currency space then. The dollar index has inched higher, recovering from a 2-week low level as safe haven demand has risen from heightened risk aversion.
The world of commodities, crudes fell by almost 7% after seeing 4 days of gains amid concerns over rising global supplies and growing fears of an economic slowdown. Remember, OPEC and its allies are set to meet on December 6th to discuss supply cuts.